Federal Reserve provided multiple indications that its run on ultra easy money policy that established during the pandemic is finally coming to an end, providing aggressive policy moves to head off rising inflation. This is Kiwi the Coast, your luxury real estate specialist, helping you maximize and sell the value of your coastal home. Now, new to the channel, hit the subscribe button. Let's dive in and see what they're up to. First thing they're going to be doing is reducing monthly bond purchases. For one, the central bank said it would start to reduce the monthly bond purchases. The Fed will be buying $60 billion worth of bonds each month starting in January, half the level prior to the November taper and $30 billion less than it had been buying back in December. The Fed was tapering by $15 billion a month in November, doubled that in December, then will accelerate the reduction further as it heads into 2022. The other thing is the central bank does expect to be increasing interest rates very soon. After the Fed wraps up its reduction of monthly bond purchases, the central bank expects to start raising interest rates, which had been held steady at this week's meeting. Projections released Wednesday indicate that Fed officials see at least 3 rate hikes coming in 2022, with 2 more in the following year and 2 more in 2024. And that inflation, it's hotter than expected, isn't it? Both policy moves come in response to an escalation of inflation, which is running at its highest in 39 years for those consumer prices. Wholesale prices in November, well, they jumped 9.6%, the fastest on record, and a sign that inflation pressures are becoming more ingrained and broader based. Fed officials have long stressed that inflation is transitory, which Powell has defined as unlikely to leave a lasting impression on the economy. Okay, that's good news. He and other central bank leaders, including the Treasury Secretary Janet Yellen, have stressed that prices are booming due to pandemic-related forces such as extraordinary demand, which has outstripped supply and ultimately fade away. While there's no direct correlation between the Fed raising interest rates and mortgage rates, the filter down effect is such that we're going to start to see probably some increases and pressure on those mortgage rates. So what does it mean in the real estate business for all you mortgage holders out there? Well, while there's no direct correlation between the raising of interest rates by the Fed, because that's more consumer debt based, it is likely to have pressure and put pressure on interest rates upwards in the mortgage area. So what's the solution? Take advantage of those lower mortgage rates now and jump in and get that house under contract. Hey, I hope you found all that information valuable. Don't forget, subscribe to my channel so that you can stay up to date on all the changes affecting you and the real estate market. See you on the next video. Varum.